as promised, today we will talk about the sovereign gold bond scheme, which was introduced by the Government of India almost a decade ago in November 2015. It was introduced as a part of the gold monetization scheme, which was aiming to provide an alternative investment option to physical gold and also to reduce India's reliance on import of gold. Government had promised investors an interest of 2.75% per annum, which was later lowered to 2.5% per annum. Gold prices have risen nearly 3 times since then, and investors are enjoying not only periodic interest but also capital appreciation. On the flip side, though, the scheme is now turning out to be a nightmare for the Indian government. And this is because reports suggest that government's liabilities have now reached nearly 1.2 trillion rupees or $13 billion on account of these bonds. To decode this and to understand the real problem here, we now have Mr. Kunal Shah, Head of Commodities Research at Nirmal Bang, now joining us. Mr. Shah, thank you so much for taking your time out and joining us here on ET Now. First up, for the benefit of our viewers, help us understand how do these bonds really work. Say, for example, if I as an investor is buying this bond, does the government buy gold as a hedge, or was it unhedged completely, because of which the government is now facing financial trouble?
First of all, regarding sovereign gold bond scheme, it's a scheme where a government is giving you 2.5% interest per annum for investing in this kind of bond. So when you generally buy gold, it doesn't yield you anything. So 2.5% interest was a very big incentive for investors to invest in this scheme. But government has never mentioned whether they are going to buy physical gold or whether it is going to be backed by gold or not. So we are assuming that they have not buy any gold on account of this or have not done any arrangements as far as hedging their open long position is concerned, except for the gold which RBI is holding, which you cannot say is bought for the purpose of sovereign gold bond. So yes, it seems that government has not bought the gold, and this comes as a big hit for the government. So yes, this is a problem for them. This has become a problem for them, provided they've not bought, which seems to be the case. So they are witnessing huge kind of shortfall and huge kind of deficit because of this scheme.
Government has not clarified whether they have hedged or not hedged the holdings in these sovereign gold bonds. This essentially means it is going to be a burden for the Indian government. And do you expect any kind of impact on India's reserves on account of these unhedged positions by the government?
I don't think so. It's going to have such a big impact that it should worry people. But generally, what happens is that in this kind of scenario where government was paying interest and gold prices have risen exponentially, I remember the first tranche when it came, I think gold prices were, I remember it was around 36,000, 37,000 was the rate when the first tranche was introduced. And right now the rates are 96,000. So we have seen this kind of massive spurt, in last 8-10 years. And that money, if it is used in infrastructure development or not, so that would have provided them 10% or 12% growth or whatever. So I believe that it's a big number, but I don't think so is that big number that is going to be a very big concern for the government from the fiscal point of view.
For the government from fiscal deficit point of view, we get that point, but government also allows premature redemption of these bonds. In fact, recently Reserve Bank of India came out with premature redemption of gold bond, which is usually permitted after 5th year. At this point in time, given the surge in gold prices that we have seen over the last 1.5 to 2 years, what would your recommendation to those bond holders be? Wait for some more time if you have the option of extending it further, or would you recommend just premature payment of those bonds?
Well, I think it's a good time to take profits, right? Because you don't know in any asset class what is the top and what is the bottom. So in a times where the global economy is searching for an alternative currency, which seems to be a very, very big problem right now. So in this kind of time, gold generally provides good hedge to investors. So I'm not of the view that gold prices are going to crash and come down to levels of 70,000. That's very unlikely scenario. But At the same time, I do believe that these are the rates where one should take the profits, because the reason why gold prices is trading at $3,300, $3,350 is because of whatever reasons with which gold is going up right now. All those positive reasons are already discounted in the price. The weaker dollar, the stronger the problems between US and China. So these kind of factors are already priced in, and that's the reason why gold is trading at such unprecedented levels, trading at these levels. So I believe that this is a good time for those bondholders to take profits.
Bondholders to take profit, that's the word coming in. But apart from that, also wanted your thoughts on whether the government could come up with such gold schemes again in the future. Last year they were not issued, but any possibility that the government could probably come up with another round of these bonds?
I think government is not likely to come. This is my understanding. I don't think so. They are going to come up with such scheme, because if you look at from the government point of view, there has been a massive price appreciation. Nobody knows what is going to happen to the entire financial system, or whether we are in for the major depreciation in the US dollar or not. So I believe that this kind of scheme, very less possibility for it to get relaunched.
Of relaunching, that's the word coming in. But Mr. Shah, since you just told us that you would recommend bondholders to redeem the maturity amount, does that mean that you don't expect any significant upside in gold prices from here on? Because otherwise you would recommend staying put.
Yeah. So yes, we have developed a view where, like I said, at the start of the show, that nobody knows the top and the bottom, but it completely makes sense to book profit at these levels, because there are possible scenarios right now. So let us say in next 10, 15 days or 1 month, if the US and China sits on the table, negotiates on the trade front, and comes up with a solution, then what will happen to gold prices? What will happen to the gold prices if the ongoing Russia and Ukraine war comes to an end? So these kind of possibilities are something, which can happen in the times to come. And if it does, then you are going to see a good profit taking or a correction in gold prices. So why not to book a profit at these levels? So that's my key reason why I'm recommending to book profits rather than staying put.
It clearly seems to be the name of the game when it comes to global macros and also when it comes to gold prices. Mr. Shah, thank you so much for taking your time out and joining us here on ET Now.
If you like this video, then like, share and subscribe to ET Now.